Right, we come on to our keynote. Lucian Cook heads Savills residential research team and is widely recognised for his incisive, thoughtful analysis of UK property trends. He's one of the most quoted property commentators, frequently appearing on radio and TV. He leads a team of 25 researchers who cover everything from social housing to the prime markets of central London, development land, residential investment, provides consultancy advice to landowners, developers, house builders and investors. Having known him at Media Clash via our creative work on Savills research, I can attest personally to his wisdom and very, very thorough approach. Lucian, we're delighted to have you give the keynote to the Bristol Property Symposium. Lucian.
Brilliant. Thank you very much, Greg. What a wonderful introduction. So what I thought I would do is talk you through what happened in the property market in what was a quite extraordinary 2020 before moving on and having a look at perhaps what might be around the corner with a particular focus on Bristol and its surrounds. So if we sort of kick off by having a look at what I've called 2020 in review, then there is little doubt that it was a year, an unprecedented year of events. I think those of us who were working through that period of 2007 and 2008 probably thought we had seen the biggest economic disruption and social disruption within our working lives. And then to see the events of 2020, I suppose, has made us pretty much reevaluate those thoughts. So here we are in 2020. We started with the briefest of Boris bounces at a time when the events of Wuhan were somewhere in the background of the news agenda, certainly within the UK. But over the course of the year, we got to know some new individuals, whether it was a new leader of the Labour Party in Keir Starmer, or whether it was the Chief Medical Officer of Chris Whitty. And the events and the way that we looked at things undoubtedly changed, whether it was the experience of lockdown, homeschooling, home working, our appreciation of the NHS, all of which had a significant impact on the way that both we looked at life and also the general economy. Then what we felt was some light at the end of the tunnel, the government very keen to get the economy moving again with schemes such as Eat Out to help out. Good news towards the back end of the year as a Brexit deal was signed and the first of the vaccines was discovered and that was made public to the available, and then perhaps a slight dampening as we got to the end of the year as we saw this strong second wave in terms of COVID-19 infection. So it was, without any shadow of a doubt, a year of unprecedented disruption. And that really played out in the economy. So this is one of my favorite charts. I'm a researcher. I have a bank of favorite charts. It is not too sad a thing to say. But this looks at what happened to monthly GDP over the course of 2020. And you can see there the scale at which the economy contracted in comparison to what happened to that period of 2007, 2008. And then indeed the speed at which it bounced back through the summer and autumn months before again towards the back end of the year we saw the effect of increased social distancing restrictions essentially curtail that economic recovery. So in many ways what we saw from an economic perspective was unprecedented, and I think there were times when many of us expected the housing market to be very severely affected by that level of disruption. One of the other things that we know, and I suppose this comes back a little bit to the comments which Marvin made, is the way in which this has played out across the economy has been far from even. So my next chart looks at economic output by variation to the different sectors. And I suppose from the view of the housing market, the important thing that we have here is, yes, this feeds some of that social inequality that Marvin was talking about. But equally, we found that people employed in some of these sectors were probably disproportionately within the affordable housing sector or the private rented sector. So to a degree, homeowners have been somewhat insulated from the worst of the economic impacts of the coronavirus pandemic. In terms of what that meant for the housing market, well, the housing market was anything but normal. I remember being in about April of last year and saying that I thought we would see house price falls of, say, 5 to 10% in the housing market, across the housing market over the course of 2020. And I was in the minority. There were plenty more who were saying they thought the falls would be steeper and the impact on transactions greater still. But what we had was the first modern day recession where the economy went one way and the housing market essentially went the other, particularly as we came out of lockdown. And there were some clues as to why that might be the extent. There were some clues as to why we thought, in the first instance, the impact on the market would be much less than, say, 2007-8, or perhaps in the early 1990s. Firstly, in the run-up to the downturn, we hadn't had this prolonged period or bull run in the housing market of strong house price growth, a lot of that reflecting the Brexit uncertainty which we had in the run-up to the pandemic. We also, of course, had this ultra-low interest rate environment, and certainly in the early stages of what we were seeing, this pretty strong expectation that it would be a V-shaped downturn and recovery. In addition, of course, the government was very swift to intervene in the economy, whether it was through the furloughing scheme to protect jobs, preventing forced sales coming to the market, whether it was the protection of earnings or whether it was mortgage holidays, or whether it was the stimulus that it sought to give the housing market through a stamp duty holiday, which really gave some urgency to perhaps some bigger trends that were going in that very few of us would have anticipated at the beginning of this lockdown period. What it meant in reality was that the market was really driven by the haves as opposed to the have-nots, those with the financial security to be able to move rather than those who perhaps were more exposed to the economic fallout. And for that group, the experience of living and working at home and homeschooling acutely brought into focus some of the perceived limitations of their existing home. So a big reassessment of housing needs and priorities, a real requirement or desire for people to find more space, both inside and outside of their home. That behavioural change in the way that we looked at our home, essentially for the first time, overrode the economic position. And as a result of that, we saw house price growth of over 7% over the course of 2020 across the country as a whole. And when it came to transactions, by the time that we got to the end of the year, they were running at 34% above December of 2019. And mortgage approvals were some 61% higher, suggesting a very strong run-in for the housing market until the end of the stamp duty holiday. But it wasn't a one-size-fits-all picture. Whereas the sales market was incredibly strong, we did see a much more mixed picture around rents. And we saw some falls in rental markets, not just because that's where some of the economic fallout was greater, but also because people like young sharers realised they didn't have to be close to the office. They could hand back their keys at the end of their tenancy. They could go back and live with their parents and still be able to work remotely while saving on some housing costs. So we had some pandemic-specific factors that were also impacting the rental market, albeit perhaps in a different way. In terms of where the activity was strongest, this is some data taken from 20CI, and it looks at the number of agreed sales, both since the 1st of June and over the course of the whole year in 2020 compared to 2019 across different price bands. And you can see that pretty consistently across the market, we had stronger levels of transaction activity in the period post-June than we saw in the same period of 2019. But what was unprecedented was the scale of the increase in activity, particularly in some of those markets bunched around the £500,000 limit on the stamp duty holiday. So from June, the beginning of June to the end of December, transactions between £300,000 and £500,000 across the country as a whole up by something like 82%, between 500 and a million up, more than doubling, up by 106%. And again, very strong in that market above a million, where perhaps people had the housing wealth to fall back on and were able to act on some of those changed housing needs and priorities. The way that played out across the country was varied. The strongest markets tended to be within and at the edges of the commuter zone of London. And when it came to the southwest, it was really some of those lifestyle relocation markets that saw the strongest activity, whether it's the South Hams, whether it was North Devon. Where then did Bristol and its surrounds fit into that? Well, if we look at statistics for agreed sales over that period since the 1st of June, you can see in the UK as a whole, they were some 40% up on 2019. And when we got to the southwest, given its very strong lifestyle offering, a market where it attracts that lifestyle relocation market, a market which probably became more accessible as the pull of London became a little bit weaker. We saw higher levels of transactional activity, up by 49%. And in that market above £1 million, that most affluent market, sales more than doubling across the southwest. In the city of Bristol benefited from that improvement. Look at that market above £1 million, sales more than doubling. Perhaps not quite as strong in the market as a whole, but still the number of deals up by 36%. And if we look at the surrounds, a broadly similar picture. In fact, the total levels of market activity or market activity around the whole market, slightly stronger in the surrounds of Bristol than they were in Bristol itself. And that's something which is replicated across all urban markets that we see within the UK. And in South Gloucestershire, that very strong surge in the sales being agreed in the market above £1 million. You know, figures which we never would have expected as we sat there back in April and May. In terms of how things otherwise might have played out in Bristol, these are the value maps of the area, and the darker the colour, the higher the average value for the area concerned. So those deep dark red areas that you can see on that map are where average values of everything has sold have risen, are above some £800,000. Whereas in the lighter blue areas, they're below 200,000. And across Bristol as a whole, as we know, it is a very varied market, which presents a whole series of housing challenges across the city and its surrounds. But interestingly there, I suppose, for those of you who are interested in the top end of the market, that strong sort of wealth belt running southwest out of the epicentre of the Clifton market through the likes of Sneyd Park and Abbottsley, and then high values equally in what my mother-in-law likes to call the Bristol cocktail belt. They're the sort of villages where people are drinking Long Island iced tea just as Homes Under the Hammer is starting. They're your Barrow Gurneys, they're your Chew Magnas and your East Hartrees. So that is where we've seen some of the white heat of activity within the market. So that was 2020, pretty unexpected. The question, I suppose, is where do we go from here? And the first thing that we know is that nothing distorts a housing market like any kind of pre-announced stamp duty measure. And you can see that within this slide. You can see that strong peak in activity that we saw in March 2016, just before the additional 3% was applied to stamp duty for additional homes, those being investment purchases or purchases of second homes. I suppose what differs this time round is that we have a stronger groundswell of activity as we come up against the next stamp duty event, which is set for the 31st of March. And that really is because for many people, the stamp duty holiday is the icing on the cake, whereas the Victoria sponge is probably that change in what they perceive they need for their home. Nonetheless, I think there will be a distortion in the market. And one thing is for sure, and that is that the conveyancing lawyers of Bristol will be burning the midnight oil from now until the 31st of March to get those completions through the door to save buyers up to £15,000 on their house purchase. And as we know, there is going to be real pressure. Some people will miss out. There is great speculation as to whether or not the Chancellor or the Treasury will extend that stamp duty holiday to protect the people who might just miss it. And in that respect, the petition that was put forward to extend that stamp duty holiday beyond the 31st of March obtained over 100,000 signatures. It resulted in a debate in Parliament. The result of that was that the Treasury Minister, Jesse Norman, essentially stonewalled on what might happen going forward. And he was noting that it was that time-limited aspect of the stamp duty holiday which had meant that it had been so effective in adding some urgency to the market and stimulating that economic growth that comes from a more vibrant housing market. What he also said was that they had listened to the concerns and they were continuing to listen to the concerns, and that he could not make any statement outside of a fiscal event. And what that means, I suppose, is we will not know whether there will be either transitional arrangements or an extension of the stamp duty holiday until the budget in early March. And while I wouldn't say the door is quite closed on that, what I would say is that if you're doing any planning around that stamp duty, you should be working on the assumption that you have to have your completion done by the end of March. And thereafter, I think what you will see is a lull in activity, if nothing else, because we are seeing transactions pulled forward into that period. So stamp duty undoubtedly would distort the market in 2021. But what will be most important, of course, is the economy. So what we have here is a quite beautiful chart with shading, with bars and with lines. The lines have even got dots, which look at the economic forecasts coming from Oxford Economics. Oxford Economics are pretty much a middle-of-the-road forecaster. They rarely go out on a limb on their forecast. They're pretty much in with the consensus. And in the bars, what we're looking at are those quarterly movements in GDP. Again, you can see that very pronounced impact on the economy of the first lockdown and the release of that lockdown thereafter. And I think what we're likely to see, or what Oxford Economics are likely, or telling us we're likely to see over 2021, is a further contraction in the economy in the first quarter, but not nearly as severe as we saw over the second quarter of 2020. And then a pretty strong recovery, that coiled spring, if you like, that was talked about earlier in terms of recovery in economic activity coming out of then. But still, I suppose you have to have the reality that at the point that that economic recovery comes, unemployment levels are going to be much higher than we've become accustomed to. Not as high as we've seen coming out of previous recessions, but still that will result in some short-term caution and volatility across the UK housing market. As we look longer term, I think there are probably going to be two other key economic drivers. One thing is for certain, the experience and the cost of the second lockdown, the cost to government, is going to mean that there is a very strong focus at some point on tax revenues. And so at some point we will see an increase in the tax burden. But at the same time, because of the level of economic disruption, the expectation is that interest rates will remain at their very low levels for the majority of the period of the next 5 years. And that will leave some capacity for house price growth, and it will leave some breathing room within the housing market. That probably will be the biggest long-lasting economic effect of what we have seen as a result of COVID. So what do lead indicators tell us? You know, what do the short-term indicators tell us? Well, here again, on the left-hand side, we go back to that wonderful data from 20CI. If you look at the far right-hand side of this chart, you can firstly see that agreed sales have remained higher than they were in that broadly average period of 2017 to 2019 in and over the course of January. Perhaps not as strong by reference to that benchmark as they were through the second half of 2020, but still, even given a slightly higher fall-through rate, you've got levels of agreed sales in excess of 20% higher than where they were in the same month over the period of 2017 to 2019. What we can also, though, see is what's happened to new instructions. New instructions have broadly followed a similar pattern. But throughout the period since July 2020, they have been somewhat below the number of sales which are being agreed. And that suggests to me that as we come to the end of the stamp duty holiday, with all of that activity in the second-hand market, we are also going to be facing the prospect of some stock shortages, which I suspect will, to a greater or lesser degree, underpin pricing. And the other thing I would say around this chart is, of course, that takes January as a whole. We have to remember that in the first part of January, we had that moment where people were sitting on their hands as we went into the most recent lockdown. So if we look at how transaction levels or agreed sales have panned out across the course of the month, you can see that over the month as a whole, they have gained further momentum. And that gives us some confidence that some of these big behavioural changes that we're seeing that are driving the housing market are still in play. So what will that mean for 2020 as a whole? I think it will be a year of three parts. I think in the first part of the year, certainly till the end of the stamp duty holiday, you will see continued strong market activity and the prospect of further house price growth. Exuberant attempts to beat the stamp duty holiday. The reality is that some people will pay £25,000 more on a property to save £15,000 in stamp duty. And that ongoing experience of living in lockdown, for those people who were just thinking about moving, do we need new space? I think the experience of the second lockdown is going to mean, actually, they're going to say, yes, we do need it if our working patterns are going to change, if we need more space for our family. And of course, we also have the last days of Help to Buy version 1. Thereafter, I think we will see a lull in market activity. You lose the boost from stamp duty. Some of those economic realities are brought into focus. And what we would refer to as the end of the beginning of the great work from home experiment, as people start to get into focus how many days they are likely to spend in the office, how many days they are likely to be working from home, starting to get towards something of a new normal. The question for me is, how long does that lull in activity last? And I think the thing that's changed, and the thing that means that this is fluid, is the speed of rollout of the vaccine as we go forward. And it may therefore be that that lull in activity is shorter than we were previously expecting. And it is as you get that rollout of the vaccine that you start to see the return to the fundamentals. Falling levels of unemployment, low interest rates, slightly offset by the prospect of some tax rises, and a movement of an equilibrium around work-life balance, the need for space and manageable commutes. All of which I suspect will continue to drive activity in the housing market, and against the context of those low interest rate environments, still leave some capacity for further house price growth. So that's the housing market as a whole. What I wanted to do was just finish with a couple of slides on the development market. This slide's an absolute cracker, because as I press the button on my mouse, one by one, each of these boxes will fly away and reveal a building picture as to where we are in the development market. That key point around the housing delivery, which is so important, as the Mayor has said, in both providing greater levels of social equality across Bristol, but also meeting its housing needs. So one thing we do know is that the development industry is going to be exposed to some of that market activity volatility that we've talked about in 2021, and there will be some caution that results of that. Equally, they will know that the end of Help to Buy is looming. It is due to end in April 2023, and in terms of the government's aspirations to provide more low-cost home ownership, is likely to be replaced by a first homes policy, which is going, in many cases, to come out of the affordable housing requirement. And that will change some of the economics of viability, and it will also cause some sort of disruption in terms of developers' views of what is deliverable and what speed. What we also know is that we have a planning paper that very strongly confirms the government's desire to deliver more homes. But we also know that by holding the local authorities essentially to account on their housing delivery, by continuing to apply this housing delivery test, and given the way in which they are constructing their housing need numbers, and we'll look at this for Bristol, that could create some tensions between national and local politics. Irrespective of all of that, one of the things that we will undoubtedly find, particularly as we see first homes potentially eat into some other forms of affordable housing delivery, there will undoubtedly remain a pretty significant shortfall for truly affordable housing provision. So innovation within that part of the market remains a significant requirement. And all of those things mean that there will be some changes in the trade-offs between affordability, viability, and deliverability. There will still be some real challenges in the housing delivery sector, but the people who rise to those challenges, I think, will have an incredibly successful time driven by that underlying requirement for housing need. Where then does Bristol sit with all of that? Well, here we have a map of Bristol. You'll be delighted to know that this is my final slide. And you can see here two things. One, Bristol has its own green belt. It also has a number of sites of special scientific interest. And as you push up against the River Severn, there is also a fairly extensive element of floodplain. And that means the land supply that you have critically within Bristol itself is important. The good news, I suppose, from a housing delivery perspective, is that Bristol, unlike most of the rest of the country, currently has a relatively good land supply, well above that measure of 5 at 9.7 years of land supply. But I don't think that means that we can be complacent. I still think developers and the industry will be looking to eke out further development opportunities, not least to deliver the diversity of housing stock which Bristol needs. The reasons I think there will still be that pressure are as follows. Annual housing delivery across Bristol over the period of the last 3 years has been about 1,500 units. Yes, that meets the 2011 target set out in the local authority core strategy. But note that core strategy dates to 2011. And if you look at the standard assessment of housing need coming from the government, then Bristol is at the max. That housing need has been increased by 35%. So whilst it has been providing 1,500 new homes a year, its target will move to over 3,000, up towards 3,200. And that is just half, or that means the annual delivery is just half of the housing need. And I think it's for that reason and the diverse nature of the housing need that means that there is a challenge for the industry to rise to, but there also will be some significant opportunities arising out of that. So there we are. That's me done. I think I've covered it in about 25 minutes, and I'm going to hand you back to Greg.
Lucian, thank you ever so much. I love the way you went from the macro to the micro, right the way down to your mother-in-law's cocktail belt around Bristol. You clearly, of course, you know your data and analysis, but you know the area as well. And I wanted to pick up that area point. Clearly, the Southwest has long-term has continued to outstrip other areas. Can you talk about some of the factors, perhaps separate to the pandemic, which continue to power the growth in the Southwest in residential property?
Yeah, well, I think Bristol has really been at the heart of it. For those of you who know me, you will know that I grew up near Wedmore, and one set of grandparents lived in Bristol, so I know Bristol relatively well. I also had the joys of taking my family back to Bristol this summer and doing the Banksy Trail. It was an absolute hoot. And very eye-opening for my 9-year-old and my 12-year-old. But one of the things I would say is that over the period of the last 15 to 20 years, Bristol has become a powerhouse, a much more diverse economy, and it has changed in many ways, almost beyond recognition. So I've often said, whereas Bath was posh, Bristol's just become very, very cool. And I think if it can continue to do that, if it can continue to attract talent, and I think it has a fantastic opportunity at the moment to attract graduate talent, given some of the housing pressures that you have in London, which have come sharply into focus for a number of those graduates or people currently working in London, then actually it will be Bristol and its diverse economy, its ability to pick up on things, the growing parts of the economy like tech, that will continue to put it in a very good place. And as we know, as we can just see from that map, from that wealth map, what happens in Bristol then flows out more significantly into the wider economy. I think you've also got some other things happening: electrification of train lines into the southwest, better connectivity, therefore, into the capital. That should continue to support the rise of Bath and Bristol as we go forward. So I think the platform for Bristol is incredibly strong and very exciting.
And let's just pick up that capital from capital point, that London money, which has always powered both Bath and Bristol. Do you think that's going to increase as a factor, or pretty much run as the constant that it's been for some decades?
Yeah, well, certainly what you've seen over the course of 2020 is we've seen more of that money come out of the capital. A lot of it has gone to the villages and the rural areas. But what that money also wants, if it's going into the countryside, it wants accessible countryside. So it wants the access to all of the amenities that are offered by city living. And so I think what you will see is you'll see a continuation of London money, that's for sure. I think what's become very apparent is the differential in housing costs, whether it be buying or whether it be renting between, say, Bristol and London. And I think that discovery will continue to drive money out of London. I think there is a bit of rebalancing going on generally, and I suspect that will continue. It will have been accelerated by the events of 2020. Now, clearly, I think that pace will slow at some point as we get back to something a bit closer to normality, but still, I think you're going to see that flow.
What about this point, that one of the effects of the pandemic, of course, is that people are spending more time at home and expecting to spend more time at home going forwards, working from home, so much that the older approach of adding value to a property by extending it with a view to selling actually now is about adding value in order to enjoy it more, so that actually will suppress demand, paradoxically. Do you buy that?
Well, I'm not so sure because, I think you've had a whole cohort of people who, since at least 2016 and Brexit, have essentially extended their home to its limits because they have been very cautious about taking on much more debt by trading up the housing ladder. And I think the experience which they found of late has been that actually you do that to the limit of the house, of the natural limit of the house, and stretching it beyond that becomes much more difficult, particularly if you've had that experience of home working. So I still think it will be a driver for people to continue to upsize. Clearly, those who perhaps are in the earlier stages of home ownership, who perhaps don't have the equity behind them to be able to do that, I think you will see them continue to extend because for many that will be the cheaper option. But whichever way you look at it, we've got a much tighter focus on space, and we've probably also got a much stronger focus on the quality of the living environment that we have more generally, whether that's access to outside space or whether it's missing all of the things that go with urban living.
Now, on your behalf, I'll caveat this question on the basis that this isn't your direct area of professional expertise, and it is about the working from home effect in terms of commercial properties and city centres, and of course the continuing to some extent working from home factor. If you were to apply something of the crystal ball approach which you applied to residential property, how would you see the commercial property sector because of that effect of working from home? Material or diminishing over time?
So, I mean, clearly there's been a lot of chat about what does the office look like in the future? What demand will there be for office accommodation? And I've listened to my colleague Matt Oakley in our commercial research team wax lyrical about this on numerous occasions. And his view is that there will still be a very strong place for the office. What the office does might change. People may well work from home more often, but they will still need the office for social interaction, to deliver that level of creativity, to provide the training they need to more junior members of staff, to meet clients. So I think, I do think you are still going to have demand for office space. And certainly if you look at those younger generations, the younger generations are absolutely craving a return to the office because of all of the other benefits, that it brings. So what you get from an office might change, but I think fundamentally the demand for those offices won't. And of course, in many cases, what we have is a pretty inherent undersupply of new office delivery going forward. And I think that will also play out in the office market more generally. But it may also mean that we reconfigure the offices that we live in. They serve a slightly different purpose. So, it's going to be a watch this space. I think it's always easy to knee-jerk reaction and say it's the death of the office. It undoubtedly isn't. Clearly some challenges in the retail sector, but that provides a lot of opportunity for repurposing. And that in some cases will play to residential. in some places it will play to other uses. And wherever you have this disruption, you're going to have opportunity within the property industry.
And presumably for Bristol, with the propulsive growth, all the factors you've talked about, the increasing cool factor for Bristol, the diverse economy and so on, with that propulsive growth plus the fact it effectively is, it's a de facto capital of the West, presumably even if there may be factors inhibiting commercial property growth in the short term, subsequently commercial property will continue to keep rising in Bristol as a factor. Would you support that rationale?
Yeah, as long as the Bristol economy continues to gather momentum, let's get through this disturbance. Let's not say it's been easy in any way, shape or form, but if the fundamentals of what Bristol has to offer to continue, and I don't think there's any reason to suggest that they won't, then clearly, I think it's got a much brighter future, particularly as more people discover it.
Yeah. Okay, one last question for you. Back to your home patch of residential, and specifically in the context of Bristol. Other than all the external variables, the rate of that bounce back, the coiled spring and so on, which would apply anywhere, are there any additional threats to the robustness of the residential sector in Bristol, do you see?
Not any that I would say are Bristol specific, to be perfectly honest. I think it faces a number of the challenges that other parts of the housing market face. The provision of affordable accommodation, the pressures that there are on the private rented sector are just two. I think it will be very interesting over the period of the next 10 years to see how institutional investments in private rented stock affects the Bristol market as we start to see those private landlords come under a bit more regulatory and fiscal pressure. I would imagine you would think that there is a very strong potential for a pretty vibrant build-to-rent sector or multifamily sector within Bristol. But equally, I think with households renting for slightly longer life stages, I think you will also see that diversify across the Bristol market.
Lucian, we're going to finish now, and I think there's multiple areas that you covered, and there's an awful lot of food for thought. What I took from it, one key message is, yes, of course there are challenges, and in the very near term of interpreting what's happening, but I think your key word there was opportunity, that one way or another, there's massive opportunity for property companies in Bristol precisely because of its strength and vitality as a city. But for your wisdom and your insights today, thank you ever so much for your contribution to the Bristol Property Symposium, and good luck with interpreting the rest of the year. Lucian Cook from Savills, thank you very much indeed. Thank you.